I think we're going to begin the easing process this year. The labor market is slowing. We're seeing demand for new hiring down considerably. There's been a drop of about 4 million in unfilled job openings. I also think that the seasonal biases in the data, again, may open the door for the Fed to get underway, whether it's July or probably more likely September. We think that the Fed is on its way to take back some of the extreme tightening steps of 2022 and 2023. This is an interesting time. As we were just writing in our mid-year outlook release today, it's a period in which the labor market is slowing and profits are accelerating. Last year, if we took a look at global corporate profits excluding Mag 7 companies, it was a 7% EPS decline, and yet the labor market was strong. Now we think that the labor market is reversing places and it's slowing down. So this is, I think, going to allow the Federal Reserve to move back a bit. It's not zero interest rates. We're not asking them to micromanage the economy, but that's what they do.
Okay, so just for the record, Stephen, Citi House view is you're looking for 3 cuts from the Fed this year, yes?
At Citi Global Wealth, yes.
Okay. All right, let's get that out of the way. So the Fed's going to deliver, sounds like, and 3 is probably more than the market is pricing, which is fewer than 2 right now. And you're seeing, or rather you think that earnings growth is going to broaden. So it looks like at least 2 big elements are in place to keep this market trading up at about 21 times.
Well, some of the things that we just noted, last year we had very depressed expectations. Clients, the markets really believed that inflation could only accelerate and that recession was inevitable. This combination that you can't buy stocks or bonds. And we've come a long way. We've had a 16% rally in the S&P 500 in 6 months. We don't think it'll be 32%. But just as you noted, we had a very, very narrow market, the narrowest since 1998 in terms of the number of companies that had a gain larger than the index. It was very hard to outperform if it wasn't for a couple of tech companies last year. And what we expect is that 10 out of 11 sectors will likely have earnings gains this year and more regions. As I just mentioned, if you take a look at earnings outside the United States, negative 6.5% last year. We think that swings positive in 2024 and that it continues to grow in 2025. Now, that's really critical. And it doesn't mean that valuations will be the same, that everybody is a tech stock. It's not anything like that. But it is a positive catalyst when earnings go from declines to gains. And we think that we can broaden portfolios, diversify portfolios, and not give up much in terms of return.